Access Bank say they expect interbank rates to decline further today as the market anticipates an OMO maturity of 157 billion naira and refunds from the retail secondary market intervention sales. And I have with me Ladi Belo. He's a fixed income dealer at Access Bank. He joins me now to review activity at the fixed income markets this week. Thank you so much for joining me on the show today, Ladi. Interesting week we've had in the money market. I'd like to get your take on what we've seen so far.
Thank you for having me, Kenneth. The money market remained relatively tight. Trading sessions, we've seen counterparties demand for any funds that are available in the markets. But since we've had the NTB auction on Wednesday and the OMO maturity yesterday of about 157 billion, we've seen money market rates decline significantly by an average of 915, about 900 basis points day on day, to close around 2.8 and 3% or 3.5% respectively on the OBB and overnight. The decline in rates largely as a result of the net OMO credit into the system yesterday, as the CBN did not mop up all that was maturing into the system yesterday. Also, we had a retail refund into the system, causing an overall improvement in market liquidity coming into today. But we still estimate market liquidity estimated at about 70 billion. So market is tight, and hence why we've seen in the treasury bills market. The OMO side of the curve has remained largely quiet due to the unattractive rates at the moment. We're seeing rates on the long end trend between 5 to the 5.6, 5% handle on this curve. The new OMO bill currently is being offered at a high of about 5.7. Nevertheless, at the auction yesterday, rates closed at about 8.99%, excuse me, on this front. In the bonds market, we've seen rally since the preceding auction. We've seen rates trend down significantly, an average of 200 basis points across the curve. We've seen most of the attention shift towards the OMO space to the bond market simply because of the unattractiveness in yields and DMO's intention to continue to raise debt at the lowest level possible.
All right, but the DMO recently released the figures for the markets this for the first quarter of the year, talking about the public debt stock for Nigeria coming in at 28.6 trillion naira at the end of the first quarter. I'd like to get what you make of this recent release from the DMO, and also some of the other figures they released as well, talking about the debt service, the amount of debt service Nigeria has been putting on in the first quarter.
Okay, well, the DMO is trying to keep its debt level or debt servicing cost at the lowest level possible. As we are aware, we still have quite a way to go in terms of what they have to raise. The auction is going to be conducted in the course of the year. The amounts that will be offered are also, would also gradually increase as we approach the fourth quarter of the year. On the bond side as well, we've seen the DMO increase the supply of the bond maturities for every bond auction. So we've seen a steady rise in what the DMO is willing to sell and the level that they're willing to sell this. At a previous NTB auction, we've seen the DMO willing to sell more than what is on offer. So the general intention is for them to be able to raise the debts or the funds at the cheapest level possible. And so far, they've done a pretty good job at this, as we've seen rates, for example, in the markets trending down significantly. At the auction on Wednesday, they successfully rolled over the 88.8 billion as anticipated, but we saw stock rates drop significantly by about 17 basis points. Coming from where they are, it's a bit significant. So we saw the demand remain heavy at the auction, especially on the one-year paper. We had the highest bid-to-cover ratio of about 4.91 or 4.19 times amongst the three tenors. So we'll continue to see the DMO try to offer as much securities as they can at the lowest level possible. So we expect rates in the NTB space to continue to dwindle, and also within the bond market.
All right, Dami, on the FX space, what has played out this week? And I'd also like to get your take on what Moody's is saying about foreign currency availability. Moody's says they see that it's going to tighten further.
Okay, we've had a few outstanding obligations by the CBN. We also don't have offshore counterparties bringing in the usual funds that we've seen early in the year. So by and large, the availability of FX remains, and we expect this to continue to be the case until borders simply open up and then travel begins to filter into the market. Until that happens, we'll continue to see a scarcity in the availability of the amount of FX that is willing to be passed on to the market players in the system. As it has been in the past, the main driver, the main provider of the supply within the market has been the CBN, and followed closely by the offshore counterparties. Now that the CBN isn't necessarily into the markets, the scarcity will remain up until they are able to give investor confidence that they are able, the funds that they bring in is easily that they can easily repatriate these funds out. They are lacking at the moment.